Yes, good morning here from Berlin. Thank you very much for joining our call, arguably a bit on short notice, but for understandable reasons. We think we will have two introductory statements, firstly from Matthias, our CEO, and then from Julian, our CFO. After that, after the brief statements, we are looking forward to answering the questions that you might have. With that, I'll hand over to Matthias.
Yeah, good morning, everybody. Welcome to our analyst call. We have exciting news that we have published this morning about KKR's offer announcement. Julian and I would like to take the opportunity to explain why we think this is the right path for the company and a great opportunity for our shareholders. We also want to give you context on the update of the financial expectations for the current and the next financial year. We'll keep this brief to have time for your questions. Let me start with an overview and the strategic rationale. As you know, in the past years, Axel Springer has achieved tremendous transformation from a pure German print publisher to an international digital company with strong pillars, digital journalism and digital classifieds. In the beginning, it was mostly about restructuring of the business and turning it around before we've invested heavily in the digitization. Over the years, the strong organic growth in our digital activities showed us that we not only picked the right assets and management teams, but that these assets are also operating in markets that offer strong growth opportunities. Today, we stand at a point where we show decent organic revenue growth and where we could theoretically just focus on optimizing short-term profitability. We believe a profitability-focused strategy would be short-sighted and unsustainable over the long term. The industries in which our business operate are constantly evolving, and we have to continue to evolve with them if we want to stay competitive. We are convinced that by implementing the investment and growth strategy we presented last year, we will ensure long-term competitiveness and sustainable growth of Axel Springer. Our strategy will cause negative earnings effects in the near term, but we are acting in the best interest of the company. Hence, we will stick with our planned growth investments in 2019, despite a more challenging macro environment, especially for the job classified business. Julian will explain this in more detail. At the same time, implementing our growth strategy will require further investments in 2020. Following our Capital Markets Day in December, and after providing guidance for the current year in March, we received a lot of pushback from investors regarding our planned investments. Even though we believe this is the right path to take, the market reaction has shown that this earnings profile and our investment horizon over several years isn't really attractive for many investors with a shorter-term focus. We saw strong reactions in share price despite a very convincing logic of our investments. In light of this dilemma, our conviction for a long-term growth and value-oriented strategy on the one hand, and a significant skepticism of parts of the market on the other hand, we have evaluated different strategic options. This included looking for a committed strategic and financial partner who supports the company's growth strategy and at the same time offers all public shareholders of Axel Springer the opportunity to realize a significant part of the potential long-term value creation immediately upfront. Following a thorough process, we have identified KKR as the optimal long-term oriented partner with significant experience in digital and media sector. KKR not only fully supports our strategy to invest in the classifieds as well in digital content businesses, but also shares our culture and values. The objective of the partnership is to invest further in significant growth initiatives and the long-term profitability of Axel Springer. Having KKR as an investor also ensures the necessary financial flexibility to pursue our ambition to become a global leader in digital classifieds and digital content. Furthermore, the parties are in agreement that Axel Springer will remain a leading voice in independent journalistic activities, both in Germany and internationally. The editorial independence will of course be preserved. My colleagues in the executive board and I are therefore convinced that this transaction and the partnership would offer an excellent strategic perspective for our company and a highly attractive opportunity for our shareholders. As you have seen in the press release this morning, the agreement ensures continuity for Axel Springer as both Friede Springer and myself will remain committed to Axel Springer and have decided not to sell any shares in the tender offer and be part of a consortium. AG Springer, the grandson of Axel Springer, who is an important shareholder, is informed but not involved in the process, is supportive for the project, and will decide during the offer period what he's going to do with his shares. Julian will now give you more details on the offer, recent business developments, and the implications for the financial outlook.
Yes, hi, and good morning also from my side. Let me give you first some details on the proposed transaction and the intended public tender offer before I comment on the update of the financial outlook for 2019 and 2020. Axel Springer and KKR have signed an agreement to create a strategic partnership supporting the long-term growth and investment strategy of our company. KKR announced this morning its intention to make a voluntary public takeover offer at a price of 63 euros cash per share for all outstanding shares of Axel Springer. This offer price represents a highly attractive premium of 40% to the unaffected share price of 45.10 euros on May 29. That was a day when we confirmed discussions with KKR about a potential strategic investment. The offer price represents a premium of 31.5% to the unaffected 3-month volume-weighted average share price, according to Bloomberg, of 47.93 euros. The tender offer will be subject to a minimum acceptance threshold of 20% and further customary conditions, including merger control and foreign investment clearances. Axel Springer has entered into an investor agreement with KKR and with investment entities controlled by Friede Springer and by Matthias Döpfner, respectively. This agreement contains the essential cornerstones and legal structure of the agreed transaction and further principles of corporate governance for the company after a successful offer. In particular, Axel Springer will remain a European stock corporation, and the current executive board members will continue to lead the company. The supervisory board will continue to be composed of 9 members, led also in the future by the current chairman, Ralf Büchi. Furthermore, the parties have stated that they support the long-term growth strategy of Axel Springer. As Matthias already said, there will be no influence on the journalistic activities of Axel Springer, and editorial independence will be preserved. Matthias has also already mentioned his personal and also Friede Springer's commitment not to tender their shares in the offer. Upon a successful takeover offer, they will coordinate with KKR as shareholders. The shareholder agreement, which is obviously subject to closing of the offer, will provide that no decisions on the shareholder level can be taken without the consent of Friede Springer. We are convinced that this will ensure continuity in the governance and management of the company. KKR will have adequate representation on the supervisory board, obviously provided that the offer is successful. We, the executive board, and also the supervisory board of Axel Springer, welcome the strategic partnership with KKR and support the takeover offer. Of course, this is subject to a careful review of the offer document in accordance with our statutory fiduciary duties. As of today, both executive board and the supervisory board intend to recommend accepting the offer, given the attractive premium offer to our shareholders, which allows them to immediately realize a significant portion of the future long-term value creation with obviously no execution risks upfront. Once the offer document is published, we will, after careful review, issue a reasoned statement regarding the offer in line with our obligations under German takeover law. In order for our shareholders to make an informed decision on the offer once it's available, it is important for us to provide you with the transparency you are used to get from us regarding expected financial developments. And this is why we have done now some decisions on our investment policy. Let me explain the update that we also published in our release this morning. When we gave you the guidance for 2019 in March, we communicated the impact of the planned investments, and you know the discussions we had also on the Capital Markets Day already in December of 2018. on the financial year as we saw them at that point in time. What has happened in the meantime? We've seen a softer macro environment resulting in a revenue development below budget, especially at StepStone, so in the job classifieds business. While we now could achieve the budgeted EBITDA by cutting the planned investments in the job classifieds field, this would, and we are absolutely convinced, would not be in the best interest of the company long term. Also, the French government has introduced a so-called digital tax since we last updated our guidance. Due to these effects, we have therefore decided to stick to these investments at StepStone and therefore revise our guidance for the classified segment and consequently also for the group of 2019 downwards. You've probably already seen the details in the release we put out this morning, and there's also a detailed overview in the company presentation that you find on the investor relations website. Let me now turn to 2020. As you all know, our practice is to guide only for the current financial year. But in light of the current situation, we think it's important to provide you also with some more visibility on our outlook for 2020. As Matthias has mentioned, our growth strategy foresees additional investments in 2020 in selected areas, mostly digital classifieds and digital content, as well as investments to drive the long-term profitability of the group. From today's standpoint, these investments will result in an EBITDA in 2020 that will be significantly below the 2019 EBITDA. In the years after 2020 and based on our planning, we expect obviously the investments to pay off and deliver appropriate returns and EBITDA to improve again compared to 2020. We think it is important to see the announcement today and the offer in the context of our overall strategy, but also our near-term outlook. Putting all this together, we believe it's an excellent opportunity for the company to find a partner with which we can pursue the necessary growth path and an opportunity for our shareholders to achieve a significant and risk-free value realization upfront due to the very attractive premium offered. So this was it from our side on the offer and on the outlook, and we are now very happy to take your questions.
Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star followed by 2. If you're using speaker equipment today, please lift the handset before making your selections. Anyone who has a question may press star followed by 1 at this time. One moment for the first question, please. The first question is from the line of Sophie Julienne from Bank of America. Please go ahead.
Hi, good morning. Thank you for taking my question. 2 for me. The first one is, could you give us maybe more color on your future M&A ambition? Could you be looking for geographical expansion or are you more into vertical consolidation? And then my second question is, what firepower do you have now with KKR on your side for potential acquisitions?
Okay, let me take the first question, investment priorities. First of all, there is a clear agreement with KKR if the transaction is successful, that they're fully supportive of our strategy and our growth plans, and that requires both organic investment and inorganic investment. Organic investment into assets, into digital assets that are showing substantial and sustainable growth, namely job classifieds, real estate classifieds, StepStone, an asset that is growing 25% in its German core markets over the last years on average per year. Business Insider growing in the last 3 years by 30% per year, north of 30% per year on average. And other assets like Upday, like Politico, like digital initiatives around paid content of our German brands Bild and Welt. So with investments into marketing, investments into traffic, investments into technology and innovation and global rollout, That is one priority. The other priority, M&A, is driven by the two pillars, digital classifieds, digital content, a global market leadership strategy, since we have reached the European market leadership with regard to revenues, profits, reach. We have to go beyond Europe here, democratic markets, namely the US, but also democratic Asian markets, are of priority, of course, to grow our position in Europe, and that range from potential acquisition targets is long and large. But to be very clear, the transaction is not supposed to facilitate one particular deal. There have been speculations about eBay, despite the fact that there isn't even a decision if and what is for sale. So that is not the priority, but at the same time, we would not exclude anything that is a strategic fit to our main positions in digital real estate, digital jobs, cars with a slightly smaller priority, and then, of course, the opportunities in digital content. Although I would think here, organic investments seem to be a higher priority than big acquisition steps.
And maybe just to add to that, to the question of firepower, as you know, from the actual leverage that we have and from the communicated leverage ceilings, we have a firepower currently of roughly 1 billion euros, and we can't give you any new number now from the announcement that KKR will do an offer. But obviously, it's always good to have a partner on your side, which absolutely shares your strategic vision and has obviously a lot of financial resources.
Excellent. Thank you very much.
The next question is from the line of Patrick Schmidt with Warburg Research.
Yes, good morning. Thank you for taking my question. You mentioned several times the editorial independence, but do you see any political risk associated with that deal? So, I mean, given your media power with your German number one publisher, Bild, as an opinion leader or opinion maker, and KKR as US investor, so maybe the government might have some interest in blocking that deal. And the other one was also referring to M&A, as you stated, the minimum acceptance rate of 20%. So is there any specific plan? Is there already a investment budget allocated for the, let's say, midterm? So I'm just figuring out which kind of dilution remaining shareholders would have to accept, or which amount they should reserve in order to not getting diluted. Thank you.
Thank you. I'm going to answer the first question. So, we will, of course, respect all cartel and regulatory processes around that transaction. We do not see any particular risk in none of the areas, particularly since Friede Springer and myself, leading the consortium, are very supportive of this transaction. And since KKR has fully complied to all standards of our editorial independence and journalistic quality and fully supports that, I do not see any reason, and I do not see any risk that there is any opposition or any possibility from a regulatory side to block that deal.
Yeah, and to your second question, we have a minimum acceptance threshold, or KKR is one of 20%, but there has not been any kind of big M&A budget being set up. What we will have with KKR is a partner who really has a mid to long-term vision and has a 5-year contractual lockup, and therefore will support investments in over the next quarters and years that will then obviously pay off at a later point in time, but there are no kind of M&A baskets defined.
Okay, thank you very much.
The next question is from the line of Nizla Naizer with Deutsche Bank. Please go ahead.
Great. Thank you. I have a couple of questions. The first is on Stepstone and the revised sort of outlook for 2019. You've spoken previously about that offline to online shift that helps the organic growth of this business. Just trying to understand what's really causing this slowdown. Is it Germany macro taking an effect on the German growth rates, or is there another region that's really dragging growth? If you could give us some color as to why Stepstone is slowing down, given how resilient it's been in the past, that would be great. The second question is on the French digital tax. This is the first we're hearing of it meaningfully impacting your revenue. How large of an impact is it going to be in 2019 and 2020, and is it only on SeLoger revenue? Just some clarity there would be great. My last question is on the structure of the investor agreement, where you mentioned that both digital classifieds and digital content would be a priority. Why is it so important to keep the two together, and do you envisage, holding on to the media businesses that are structurally declining to a certain extent going forward as well? Thank you.
Maybe I head off, Nizla. Thanks for your questions. Maybe start with the digital tax. So it doesn't have any effect on revenues, it had only an effect of EBITDA. The legal situation is not yet completely clear. It's also not completely clear whether at the end this will be a line item that affects EBITDA or reflects or impacts net income. We currently, just to be on the safe side, see it as an EBITDA item, and we expect roughly an amount of around 10 million euros for the year 2019, and it's mainly impacting SeLoger and La Centrale in France. Then on Stepstone, I think what's important to see here, you mentioned the resilience of Stepstone. This is purely a macroeconomic effect. What I think is important to see is that even in this macro slowdown situation that we currently see here in Germany, the business will be growing probably low double digit in Germany in 2019 and high single digit overall, so including the obviously structurally weaker UK business. This is less than we anticipated at the beginning of the year. But I think compared to the macro situation and to other classified assets, this is still a good performance.
And to the last question, why do these two businesses, classified and content, have to stay together? The hypothesis of the management of this company is that on our way to transform the classified business from a single touchpoint business into a multi-touchpoint business, there is tremendous opportunity for cross-divisional synergies and positive effects, particularly from a content side that is becoming more and more important for real estate, jobs and car offerings in order to create user stickiness and in order to make sure that they use the services not only if they look for a new car, for a new house or for a new job, but on a more regular basis, content is king and key. And of course, ranging from eMarketer to Business Insider to Welt and Bild, we have a lot of content that is dealing with these topics, and there are a lot of data and statistics that can be used. So that is just one example where really important synergies could pay off. That is our hypothesis. We will strengthen the cooperation between the two divisions over the foreseeable future, and we will then evaluate the outcome. If the synergies, if the added value is convincing, of course these businesses will stay together because they create in this combination a competitive advantage and make us much more resilient, stronger and faster growing than the standalone businesses. If this hypothesis is not confirmed by reality and by growth and by the performance of these assets, then of course there is no need to keep them together in the long term. But that then has to be decided in a couple of years. For the moment, we think that the combination is stronger than a standalone case.
Thank you. Very helpful.
The next question is from the line of Patrick Wellington with Morgan Stanley. Please go ahead.
Good morning, everybody. A couple of questions, really. I wondered, first of all, if you could say a little bit more about the scale of the 2020 investment and where it's going to go. It sounds to me as though your EBITDA, if one assumes significant, is sort of 5 to 10%, is going to end up at about the 650 million level in that year, as opposed to the sort of market forecast of 820. So it seems quite a gap. So maybe you could just talk us as well through how that goes back up in 21 and quite what is in it for KKR. I mean, are they so convinced that that sort of 21 to 23 outlook is particularly good? And then secondly, just going back on the corporate ambition, you touched on eBay. I mean, I think the largest acquisition you've made in recent years was Sologia at 700 million. Obviously, eBay would make you a very powerful business across European classifieds and in Germany. So perhaps you could be a bit more specific about whether this deal could facilitate such an action and whether you think it might be desirable. What are the pros and cons of that? And then finally, is the possibility that a minority shareholding, which remains public, remains, and maybe just give a bit of an outlook for what those minority shareholders might expect.
Yeah, thank you, Patrick, for your questions. Maybe to start with the third one. Obviously, we don't know the take-up of the offer, and therefore the scenario that you described is definitely a possible one. But we can't give you, I think, any more details to that. And obviously, shareholders would basically continue to have the same rights than they have today. To your first question, I'm afraid we can't give much more scale of 2020, as we obviously have not done the usual detailed budgeting process. However, we believed it is important, especially in light of what you said, the market view on 2020, to be clearer that we in 2020 want to do additional growth investments, and we want to accelerate or expand these growth investments. And we will also do significantly more restructuring than in 2019. And your question, is KKR convinced that these investments we do in 19 and 20 will pay off in the years after? Yes, they are convinced. They obviously have looked into our numbers deeply, as you can imagine, and they are convinced that we are doing the right thing here.
Can you say anything more about where that investment falls? What sort of thing it might be on? I mean, you've talked about getting sellers in the real estate business. You've had to spend more money to try and attract more jobs applicants. I mean, is it that sort of investment or
Yes, Patrick, it's these sorts of investment, and the areas with the biggest additional investment are Stepstone, but also the news media business.
And let me briefly try to answer your follow-up question on eBay and the scale of investments. I mean, first of all, with regard to eBay, at least as far as we know, there is not even a decision made whether eBay is selling its classifieds business or parts of the classifieds business. There's a lot of speculation, but nobody really knows. So it's a highly theoretical discussion and a theoretical speculation. But one thing is clear: in the past, we could not even have thought about an acquisition of eBay as a whole. I mean, eBay's classifieds business as a whole. We could have only thought about parts of it. This, in theory, could change with a partner like KKR. And I think with that, we should leave the eBay example because it is so highly theoretical. But it is important that in a way the scope of potential investment targets for Axel Springer is going to change with such a partner in such a structure of a consortium where there is no need for Friede Springer and myself to control the company in that entity, where there is a kind of leadership in the governance of the company, and potential capital increases are doable in order to finance acquisitions like that, and where a very competent and potent partner like KKR can not only allocate and provide cash, but also a lot of knowledge. And that, in a way, enables us to think bigger on both pillars, digital journalism and digital classifieds. That is the philosophy behind it.
Matthias, just to follow up on that, does that suggest that the new structure is a bit like the KGaA structure that was suggested a couple of years ago, that you could have further new equity created, if you like, dilute the Springer holdings, and yet keep the Springer Dopfner holding in control of the business, if you like?
That's a fascinating question. You know that we have very concretely thought about the KGaA structure, which is exactly what you have just described. I would not call it an equivalent. It is a kind of logical alternative that shares some mutual benefits of both structures. It is not totally comparable, but you are right, the spirit is somewhat similar.
Patrick, I hope it's okay if we move to the next person so that more people can ask questions. Sorry, thank you.
The next question is from the line of Sarah Simon from Berenberg. Please go ahead.
Yes, hi. I've got 3 questions as well, relating to the guidance. So, firstly, on the digital tax, that was proposed in March, and we've had 2 sets of results since then. So I'm wondering why it wasn't, why you hadn't assumed it in your guidance. Second question, on the paid media, clearly, as you're saying, you've got plans to invest more in that, and I think you said it was more likely to be organic. But how does that tally with the guidance you'd previously given of holding the profits in that division kind of flat? And then the final question was on the jobs business. At the Q1 results, which were a month ago, you said you had very low visibility, but you were still expecting a pickup in the growth rate in the second half. Has something changed in the last month that you've now got kind of more visibility, or is it simply that the last month has been so much worse that now you can't sustain the previous guidance in terms of the growth rate for the classifieds division? Thanks.
Yes, hi, Sarah. Thanks for your questions. So, first of all, for the digital tax, French Parliament has done the resolution after our Q1 communication in early May, and probably so before we didn't have any really sufficient data, and probably also as a kind of standalone effect, it may not have even changed. You know, it's 10 million, so it's roughly 1 to 1.5% of EBITDA. It has probably would not have changed the overall guidance. So this is basically now together with the other effect, and now we have simply more data on that. We still don't have really sufficient data, as I said, whether that's an EBITDA item at the end or it's a net income item. The auditors haven't decided on that, and the IFRS board and so on. So there's a lot of uncertainty still on that, what we believed giving more transparency here, or the more transparency we give is helpful. With jobs, it is right that there is less visibility, and this has not changed between the Q1 communication and today. But the figures that we have seen over the last 5 weeks in terms of order entry and in terms of credit consumption have been worse than we anticipated 5 weeks ago. And therefore, the gap between the budgeted revenue and the now expected revenue got a little bigger. And so therefore, we had to make a decision now whether we want to reach the EBITDA and cut on the investment. That would have been theoretically possible, so we could have managed that. We took a difficult decision here, but we believe this decision is right for the mid to long-term prospects of the company, and in particular of StepStone and the position they have in Germany, that we do these investments as planned. We have not ramped up any investments, so we simply do the same investments that we have had always in the budget of StepStone. I think that's important to see here. And then your second question, I think, was the new media investments and how does this fit into the midterm guidance of stable profits. You know, this midterm guidance of news media EBITDA was based on the 16 EBITDA, and we said we want to keep it on that level or in a small range in 17, 18, and 19. We have delivered on that in 17 and 18, and we confirmed today the guidance that we believe you saw that we deliver that in 19 as well. We probably can or would be able to deliver that even after 19. However, we believe that this area needs investments also in terms of restructuring, but also growth investments in the digital content part. And therefore, we decided for the investments, and we believe just in order to be transparent, it is better to give you all this information now than to give it to you whatever in 6 weeks. And this is why we have some decisions taken now simply earlier than in the normal course of business.
Okay, very clear. Thanks.
Thanks.
The next question is from the line of Ian Whittaker with Liberum. Please go ahead.
3 questions also. First of all, just in terms of what you said about potential U.S. investments, you're a shareholder in Purplebricks, for example, which hasn't exactly had a great track record of moving into the U.S. with its strategic plans. So maybe you could just share with us sort of how you ensure that when you do step into the U.S. in a major way, that it's not that you don't have the problems that have befallen some of your other peers sort of from Europe who have tried to get into the U.S. market, because obviously that is a very competitive and complex market. The second of all, just in terms of your comment that you've achieved digital leadership in Europe and therefore you're now expanding sort of into sort of the US and potentially in Asia as well. Sort of just on that, does that mean that you're ruling out acquisitions in Europe entirely in some of the sort of verticals that you've mentioned, or just that the main priority will be ex-Europe, but you're leaving yourself open? And obviously there's a question here about eBay, but just thinking of potentially other assets there as well. And then the third thing is just in terms of obviously there's not a huge amount you can say now, but just if, for example, you were to do bigger transactions in the future in overseas markets, sort of the structure, and KKR was to provide financing, the structure of such sort of deals, would you imagine sort of what you're thinking and how they would be done? Would it be more sort of joint venture types, you would imagine, or sort of is there any other structure you'd be considering?
Okay, I take the 2 first questions. Let me take the Europe question first, because very simple. Europe remains a top priority, the top priority us, because we want to grow our position. Just because we are European market leader, that does not mean that we do not continue to invest in Europe organically and with M&A moves, because we still see tremendous opportunities and no cartel hurdles, regulatory hurdles in most of the European segments and markets. If it is about US, I understand very well your kind of general skepticism. It's world famous how corporations from Europe are failing in America. That's why we took and prepared our steps very carefully over many years. I think the company is culturally, also with regards to very personal networks, a very pro-American company. A kind of US DNA has been very important for Axel Springer for many years, and perhaps that is one of the reasons this kind of cultural sensitivity is perhaps one of the reasons why so far most of the 13 investments that we have made in the U.S. are incredibly successful. And I'm not mentioning the small investments like Airbnb, although I think the value is today 34 times higher than when we have made this tiny little investment. Let me stick more to the bigger investments. If it is Group 9, where we have started with investments into some of the assets of the now merged group, and the value of that group is significantly higher than what we have invested in, and we see potential opportunities here. If it is eMarketer, where we brought the margin from somewhere in the 30s percentages to around 50% profit margin, NBA that has accelerated its growth since we have invested, grew 3 years in a row for more than 30% top line, and has now reached profitability in the second half of 2018, and is doing incredibly well and showing big potential for add-on acquisitions that are strengthening insiders' position, but also for organic growth in new verticals in the U.S. So that just gives you an idea. We have carefully analyzed some of the U.S. classified assets, and we came to the conclusion we should not do that. We may make mistakes here or touch a falling knife, and we remain very prudent and careful and risk averse, but we see in this biggest media market in the world and in the current situation a lot of opportunities to continue that U.S. success story.
Thank you. And just in terms of the structure?
To the third question, Ian, what would we do? I mean, it's obviously a hypothetical scenario if you would do them bigger transactions together with KKR. And you're absolutely right. There would be different structural scenarios. There could be joint ventures. I would still believe the most straightforward thing would be to do it through the current structure, so through the SE, then obviously with a potentially bigger and very supportive shareholder on our side. But again, as I said earlier in this call, we have 1 billion firepower in the current structure, even without KKR. So this is nothing that neither a joint venture nor whatever rights issue, something that is on the table currently. So it's just
that's great. Thank you very much.
Yep. A short comment from this side. We have more people asking questions, but we are pressed for time. We will take one last question from Patricia Paré, and we will get back to all the others we're seeing here in the queue for whom we don't have time later after the call. Thank you for your understanding.
The next question is from Patricia Paré from UBS. Please go ahead.
Thanks. I actually had a few questions, but I'll just stick to one. I mean, is your intention to keep the shares listed post the completion of the transaction? Say, like if 30% of the shareholders decide to tender their shares, and also, like any guidance on timing, when do you expect the transaction to complete and next steps to look for?
So, Patricia, on timing, KKR is doing the usual process with the German BaFin, and as soon as they are through with that, they will be able to give some more guidance on timing. And then with regard to the potential take-up after the offer, in a way, it is what it is. KKR needs and wants 20% at least. If it's more, I think when we have to take it from there and see where they come out after the offer. So at the end, it is a decision now of the shareholders.
Perfect. So thank you very much, everyone, again for dialing in. And as I said before, Claudia and myself, we will, of course, be available for further questions, and we will get back to those who didn't have a chance to ask their question. Thank you, and have a good rest of the day.